Hey guys, I'm making you all this video because the book doesn't give you the best explanation and doesn't really show you how to complete a proper bank reconciliation, in my opinion at least. And so there's a lot more that goes into it. The book kind of oversimplifies things, but it's super important that you be able to perform a bank reconciliation so that you can understand why there's a difference between what the general ledger is showing that the business has for cash and what the bank statement is showing. Without performing a bank reconciliation, there's no way to be able to account for every single cent that's different. So it's very crucial if you own your own business or plan to own one, or if you're even working for somebody else, to understand how to perform one of these. So let's take a look here. I pulled this example off of a website called principlesofaccounting.com, and there's a link to kind of source it at the bottom if you want to click on that or type it in and go there to see where I found this. But basically what we have here is this represents the cash ledger of a business. And we're showing on the 31st of July a balance of $47,535. So this would be like in our accounting records. If we look at cash, our ending balance is $47,535.30. Now, if we go to look at the bank statement that we got, it shows that our ending balance on that day should be $50,739.57 based on what they're saying. Well, which number is correct? This one right here or this number here? Well, the answer is neither of them are correct, because there are things that the bank doesn't know about. For instance, if we had written a check to somebody and they haven't deposited it, the bank would have no idea that that check is out there. We know that we wrote a check. Somebody else knows that they received the check, but maybe they just haven't deposited it into the bank yet. So that's an outstanding check. Maybe we made a deposit like at the very end of the day and it wasn't reflected on the 31st. Maybe it showed up on August 1st. That would be a deposit in transit. And we might not know about some things such as bank service charges, maybe a check bounced, etc. So what we have to do is we have to identify the differences between what we know we've written in terms of checks and what has actually cleared. We have to identify those deposits in transit, if any exist. These items here will be things that we are not aware of. We just now found out when we looked at this bank statement that we were hit with all these fees. So what we have to do is take a moment and compare and look for differences between these two. And let's take a look and see what that would look like. So the way I would do this if I was doing this by hand would be to sit here and say, okay, let's take a look at check number 5457 for $245. Did it clear? 5457 245. So I'll draw a line through that. Let's take a look at the next one, 5458 for $12.34. Did it clear? Yes, right there. So we keep working our way down and seeing if the checks, the number and the dollar amount appear on our bank statement. When we get down far enough, we might find that some of these that we wrote a check to somebody are not showing up on this bank statement. For example, do we see 5464 for $525? It's not on here, so it hasn't cleared the bank. So these checks that appear in our cash ledger that are not showing up on the bank statement are outstanding checks. Once we look for all the deposits to see if they've cleared, we see one there, one here. And hey, what's this? What's going on here? Do we don't see this 356593. We see the other three, but we don't see the 356593. That is a deposit in transit. It was made on the last day of the month, probably like after, late afternoon, so it did not show up on the bank statement. It will on the next month's, but right now it's not showing. So these items that we've circled here, we're going to need to, these are things that the bank was not aware of. Now the things that we've circled down here, we just found out that there's $5,450 in a 11934 that we have not accounted for up here because we didn't realize that we had collected that money. We didn't realize we had earned that interest. And then also these here, we didn't realize we got hit with all these fees. So we're going to have to use all these circled items when we prepare our bank reconciliation. So let's take a look at this screen right here. I'll try to make this bigger for us. And when we do a bank reconciliation, we're going to have a beginning balance that came from the bank statement, and we're going to have a beginning balance that came from our ledger for cash. We're going to, all those numbers that we circled, we're going to factor them in, and then at the end, we're going to get a number that is the same. At that point, this is the adjusted or correct balance. We know why this $50,739.57 and why this $47,535.30, why they're different, right? That's the whole purpose of this. Because if the bank knew about this deposit in transit, it would have been reflected in the number here. And if they knew about all those outstanding checks, they would have subtracted those out. So the balance that was on the bank statement would have been $52,503.51 if the bank had a crystal ball and was aware that these checks were floating around and that this deposit in transit was made too late in the day to show up to be posted on that date. Now, on the books side, in our accounting records, if we had realized that we had collected the $5,450 from one of our customers, if we had known that we had earned $119.34 in interest, we would have added that into our number. And if we had known that this 10907 was auto-drafted for utilities and that this check was bad and bounced, so somebody writes us a bad check, we assume that it's correct and enter it into our accounting records only to find out that it was a bad check, meaning that they wrote a check and they didn't have enough money, NSF, non-sufficient funds, and so we have to deduct that out. We wouldn't have included that if we'd known it was a worthless check. We have some fees and some charges we would have subtracted as well. So if we had known everything that the bank knows, our account balance for cash would have shown $52,503.51. And once again, if the bank knew everything, we would have had the exact same number. But we're not done yet. Our cash account is showing a balance of $47,535.30. We know that is incorrect. We know that it should be showing $52,503.51. So in order to take this number and make it equal this, we're going to have to, you got it, make a journal entry. We never make journal entries up here because this is, we've already accounted for all this. This is just something, we have to have a number to compare this to make sure that things balance so that we understand the differences. So it's not necessary to make journal entries for any of these numbers up here. And if you do, you will mess up the accounting records. The book side is the only side that's going to require journal entries. So let's scroll down a little bit further. And if we look here, this could be done separately. The way the book does it, there's a bunch of different journal entries. This is a compound entry, meaning we have more than one debit and more than one credit. Obviously, everything has to balance. We have to account for the utilities expense. The $462.06 is these two combined. We're not just going to just not try to get that money back from the people or not try to get a valid payment from these people. We're going to pursue it. So we're going to add this back to accounts receivable. We previously had written it off. We're going to add it back to accounts receivable. We had that service charge. We need to record that as an expense. We received, it says up here in the notes at the top, $5,000 was a notes receivable and $450 was interest, right? And we also had the $119.34 of interest we earned from just leaving our money in the bank. We need to separate the note receivable from the interest because there are tax consequences and you have to pay taxes for interest income. But this receivable here, maybe we had lent somebody some money. I'm not sure what the example says. But if it's money that somebody's repaying to us, you don't have to pay taxes on the repayment of principal. You just pay taxes on the money that you earned for loaning it out. So when we're done, we make this entry It has to be posted to the ledger, obviously, and once that is taken place, our new balance in cash will be $52,503.51. So the whole goal of this is to have an understanding of why those two numbers are different, which we have accomplished. We understand down to the penny, we understand every single thing that is leading to there being a discrepancy between those two numbers. And then we want to make a journal entry to adjust this number to equal what it should be. Thank you for taking the time to watch this video, and please let me know if you have any questions. Have a great day.